Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, taking a look at WBD. It's happening, Ron Paul meme. They are actually splitting their business into two separate public entities. One is going to be streaming and studios. The other is going to be global linear networks. Just a couple of months ago to a year ago, whenever it happened, they reorganized their business structure into global linear networks and streaming and studios. So a lot of investors, myself included, thought that was the precursor to spinning off the businesses. I thought they would spend more time paying down debt, but it seems like they're ready to just split the two apart and move forward as two separate entities. David Zaslav will remain as the CEO of the streaming and studios business. The current CFO, Gustav, whatever his name is, will become the CEO of the global linear networks, and they will trade separately. Global linear networks will retain a bit of the streaming and studios holdings so they can monetize that to pay down debt, and we'll look at the capital structure and all that stuff in a second. But in general, I think this is a good thing for investors. This is a stock that hasn't done very well in the long run, in the short run, whenever you want to look at it. If you're buying in that like $7 to $8 range, that's probably the right spot to buy it at. But now that this news is out, I think investors will be a bit more interested in this company, especially the streaming and studios business, which is probably more akin to Netflix and what this combined entity is, because that global linear network business is kind of shrinking and investors don't love that. And it is kind of funny that a company that just did a reverse merger in 2022, April 2022, so somewhere around here, when it was trading at 24 bucks, when it merged Warner Brothers and Discovery together, is now taking that merged company and splitting it into two entities again. Slightly different split, but since the merger in 2022, the stock is down more than 50%. So if you're a shareholder since then, not too happy. If you're a buyer in the last year or two, there's been plenty of opportunities to buy in the $7 to $8 range. I think that's kind of where the stock's been attractive to me, and that's where I have been a buyer. And I'm probably going to keep holding until this split happens and see what comes of it. As we look at the actual combination, we already know what the leading media companies that they're breaking into will be. It's going to be WBD Global Networks, ticker to be determined, and then WBD Streaming and Studios, again, ticker to be determined. They talk about the 2022 mergers and some of the milestones that they've achieved. And again, a lot of this is very much nonsensical. When the merger happened, they were projecting, $52 billion in revenue and $13 billion in EBITDA by 2024. They hit like 40 billion in revenue and 9 billion in EBITDA by 2024. So in my mind, this has been a massive failure, but they've done some things okay. Obviously, they've paid down a ton of debt. They were saddled with $53 billion in debt. That's down to about 34 billion right now. So they've repaid 19 billion of debt. They have repositioned streaming as a more profitable business. It's growing. It's doing okay. It's not Netflix by any means, but it's doing okay. They have done an okay job in stemming the losses from global linear networks. I mean, that's the reality of this business. That's what's become the transition from television to streaming faster happened than anybody expected. The 53 billion they projected really dependent on linear networks growing and continuing to grow and generate EBITDA, but instead they've shrunk. Streaming hasn't grown as fast as they expected, and that's led to mediocre results, but results that led to a price in the stock that makes it kind of attractive. I mean, you're getting a $24 billion market cap business, a $60 billion enterprise value business when you buy Warner Brothers Discovery. Then you compare it to something like Netflix trading in the $540 billion range. Maybe there's some value here if you're an investor, especially as they split these two entities apart. So as you look at what they say about unlocking shareholder value with the separation, it's enhancing focus to better position each company to maximize its potential. To me, that means, hey, we know global linear networks is kind of dying. It's a melting ice cube, but streaming and studios could be something good. It could be a third or a fourth of the value of Netflix. And if that's the case, then there's still value to be unlocked here. We know that the other business isn't all that amazing, but maybe we can do something with it, aligning investment priorities with each company's respective strategic and financial objectives, blah, 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 facilitates separate management teams with a focus on each business, provide each business with greater agility to capitalize on potential value creating opportunities, and allow these separate businesses to better target investors based on their distinct financial profiles. And really what's going to happen is you're going to have global linear networks, which is kind of a free cash flow business, probably focused on paying down debt, probably focused eventually on issuing a dividend, probably sizable dividend if they can get their debt under control. And then on the back end, you're going to have streaming and studios, which is going to grow faster than the combined business and maybe get a better multiple as a result. So how is this going to be structured? So streaming and studios is going to be distributed in a tax-free manner to shareholders of WBD, or that's the intention. Global networks will hold up to 20% of stake in streaming and studios, so that they're going to hold 20% shares when it's distributed. They're going to monetize that over time to help pay down debt. So I think the idea is going to be that streaming and studios is going to be left with less debt baggage, and global networks will have the majority of the debt baggage. We'll talk about that in a second. And then, they're going to have commercial agreements, et cetera, to facilitate the transition and make sure that there's operational efficiency between the two companies as well. How are they going to do this? Well, one thing they're going to do is they're commencing a pretty sizable tender offer, about 17.5 billion in a committed bridge facility from JP Morgan. What they're going to do is they're going to buy back a lot of the debt that they have out there with that cash, with the plan to eventually restructure that debt as these separate companies. I think their idea is going to be, hey, when streaming and studios breaks off, they're going to be able to get debt at a better rate than Global Linear Networks, better rate than the combined companies. And we know that Global Linear Networks is going to generate a ton of free cash flow. We'll probably put a lot of their debt there, but we also want the ability for streaming and studios to have some debt on their books, probably good debt on their books, but also to be able to leverage up if needed for growth, for acquisitions, etc. And as you look at how this deal is structured, they're essentially kind of capping each pool at a certain amount, and the majority of the money is going towards this Warner Media Holdings debt bucket, which makes me think like, hey, they want to make sure that they use this term loan to buy back not only the near-term bonds that would be impacting them in the next couple of years, but also a good portion of the Warner Media Holdings bonds that would otherwise go to streaming and studios, which is retaining most of the Warner Media assets, and probably put this term loan debt onto the books of Global Linear Studios. Obviously, you can't know that right now. There'll be more info that comes in the future as far as the individual companies' debt burdens, but I think that's how I would envision it happening. So what are you actually getting as an investor? Obviously, right now you hold this entire company together, but I think their idea here is our company together isn't all that exciting. Top line is shrinking, bottom line is shrinking. We have a ton of debt. So what we can do is we can break it out into one side of the business, which is WBD Global Networks, which again isn't going to grow. EBITDA is not going to grow, but it does generate a lot of free cash flow. It does generate a lot of EBITDA. We can put a bunch of our debt there. If you think about this business, it probably generates $7 to $8 billion in adjusted EBITDA, maybe a bit less. If you take a 3x multiple onto that, as far as their debt to EBITDA, you get 24 billion in debt. So they can potentially put 24 billion of their 34 billion in debt, maybe a bit less than 34 billion by the end of the year, by the time this happens. So the majority of the debt is going to sit here, is going to be supported by the EBITDA, and maybe eventually as they pay that down, as they monetize the stake in streaming and studios, they can start issuing a pretty sizable dividend, and that will attract a certain kind of investor. On the other end, you've got streaming and studios. They look at Netflix trading at, a 30x multiple to 2026 EBITDA right now, and then you see Global Networks and WBD as a combined company trading at a 5x multiple to their 2024 EBITDA. So they look at that and say, maybe if we split this into two, the market will give us a better multiple for our streaming and studios business, which includes HBO, includes New Line Cinema, TNT Sports International for some reason, all of their IP, all of their television and movie production studios, all of that good stuff. And that's probably going to be 3 to 4 billion in EBITDA. Even if you give that a 2x multiple, the rest of the 8 to 10 billion in that can rest here, and this is going to grow the top line, this is going to grow the bottom line, and it could be an interesting investment for another type of investor who's more concerned about top line growth, bottom line growth, and all of that other stuff, which isn't evident in the combined entity. When you look at WBD Global Networks, where they have live presence, sports, international sports, U.S. sports, news. They do have some digital platforms, whether it's CNN, not too exciting to report. I'm kind of surprised that they're leaving Discovery Plus here, but I guess it's connected to the Discovery Channel that's going to exist here. But it is an interesting asset for the certain type of investor. This isn't the asset I'm really excited about as I invest in WBD. So I don't know if I'll keep holding it. I'll kind of see what the financials look like, what they expect to do with the debt stack, etc. But in my mind, this has always been a streaming and studios play because this is what was going to grow to replace the lost EBITDA from the global networks business, which is shrinking. As you look at the streaming and studios asset, it's again streaming HBO Max with decent growth, growing a lot in international markets. They still have 40% of the markets that they're going to be in when they're a mature business to be unlocked. There's UK, Ireland, Germany, Italy that they're not in yet that they're going to be in the 2026, 2027. So there's growth ahead, meaningful monetization, content strategy that is pretty good. But I wish they would just be more consistent. Last of Us season 2 kind of sucked. They don't do a good job of allowing these shows to sort of do what they need to do. Like, why did they cut this show from a 10 episode order to an 8 episode order and make it less exciting than it could have been? Then you got studios. Again, it's DC, all of their movie making potential. Minecraft was just a hit. Final Destination was just a hit. Superman's coming out. They've got the Harry Potter TV show coming out in a year or so, so that's going to be a driver for streaming. But end of day, you've got this business that has 1.3 billion in adjusted EBITDA in 2025. I don't know what adjustments they're making. Studios, they're trying to target 3 billion plus in adjusted EBITDA every single year. So if you kind of combine those two together for 2025, let's say you're talking about 3 billion, 3 to 3.5 billion in adjusted EBITDA for 2025. What kind of multiple does that get? Right now, this is a 24 billion market cap business as a combined entity, a 60 billion enterprise value business as a combined entity. If you have 3 to 4 billion in adjusted EBITDA just from streaming and studios, that's growing at a decent clip, that has upside potential. Should that get a multiple that's better than 5x? Probably. So as a combined entity, this gets a pretty mediocre multiple, but they look at this and say, well, Netflix, based on 2026 EBITDA, gets a 33x multiple. If this even gets half of that, you talk about 3 billion times 16, that's a $48 billion business out of a $60 billion entity as a combined entity right now. Is that reasonable? What if it gets a 20x multiple? That's 60 billion right there. So there's no value in the other business. I think that's how investors kind of look at this. They say, these guys can do something with streaming and studios that they can't do as a combined entity. They can show that this business is growing, that this business isn't generating meaningful free cash flow yet, but it's going to eventually, just like how Netflix went from kind of burning money to generating quite a bit of money, and the stock went from not being all that exciting to suddenly trading at $1,200. This could be not Netflix, because Netflix is a much better business than this, but it could be half of that. And if it's even half of that or a third of that, this is still going to be a good return from today's prices just on the basis of streaming and studios. And then you get the other stuff kind of thrown in there. I think that's how you look at this investment from a split perspective. And again, you look at this capital structure move that they're making, they're sort of bringing in a lot of the debt through this commitment from JP Morgan. And I think what they're going to do is they want to have a capital structure that they can control. They're going to have this term loan from JP Morgan. They're going to buy back a lot of their longer to midterm debt, especially on the WBD side that's going to flow into streaming and studios. And then they can continue to deleverage with healthy cash flow that they have from linear networks and some of the cash flow that streaming and studios generates already. And then in the future, as they split apart, I think they're going to put the majority of the debt into global linear networks because they have EBITDA that can support it and free cash flow that can support it. They're going to leave streaming and studios with a manageable, smaller debt stack. I'm thinking if they have 32 billion debt, and when this happens, something like 25 billion goes towards global linear networks. The rest, maybe 7 billion or so, goes towards streaming and studios, so that the debt to EBITDA ratios are close to 2.5 to 3x or something in that realm. And then Global Linear Networks has that streaming and studios stake that they have to monetize, to pay down some of that debt, and the free cash flow that they generate to do the same. And then streaming and studios has much less free cash flow, which is why they get much less free much less debt, but they have the potential to grow it much faster than global linear networks, which kind of will continue to shrink. It won't die tomorrow, but 10 to 20 years from now, that business is a lot less exciting than streaming and studios is, which is why when the market looks at this as a combined entity, it's like meh. But when it looks at it from the perspective of, hey, now we have streaming and studios, maybe, just maybe, it gets more interesting. So if you're a buyer today, that's what you're looking at. That's what you're kind of thinking. It's hard to value these things without knowing the exact of everything. Like, what is the 2025 result for streaming and studios? We don't know that yet. We only saw Q1. What is the 2025 result of linear networks? We don't know that yet. We only see Q1. We'll have to look at the earnings as they come out, and we'll have to look at what the actual debt burden becomes for these two individual companies and things of that nature. But for me, this is happening faster than I expected. It's a good thing. I like it as a shareholder of WBD. Again, this is not investment advice. This is just a guy on the internet sharing what I think about this deal. And I think it's a pretty good deal. In the future, I will likely end up kind of selling this, because this is really what I'm excited about. But I still have to see, what 2025 looks like. Obviously, they're growing, but I think they need to grow this business a bit faster than they have been. They have to do a better job of monetizing it, because their domestic business hasn't grown that much, and that's where the majority of the money is. Their international business is growing a lot faster, but the average revenue per user there is pretty freaking low in relation to some of the competitors, especially Netflix in the international market. So I think they have to move into some of these other markets that are more monetizable, like UK, Germany, Italy. I think they just started in Australia. So, and obviously the movies matter as well. Is Superman going to be hit, etc. So this is going to be more variable, the studio's business, because it's dependent on hits. Minecraft, a surprise hit, but what's coming in 2026, TBD on that front. And then streaming is going to be more consistent. That bundle with Disney and Hulu and Max, real good thing for them. That's been a real success for them. So I think they're doing some things well. Obviously, if you're a shareholder from the early days of the merger, not very happy with a $10 price point. But for me, I like the deal. If this drops again into that $7 to $8 range, where I've been a sizable buyer, I will take my position up as well. But am I buying more right now? No, I'm pretty comfortable with where I'm sitting, but I do like what's happening here, and I'm certainly happy to see it. So leave a comment down below. Let me know what you think. If you want to know more about valuations, etc., watch my other videos about WBD. I've done a couple on those. Like the video, subscribe, and all of that good stuff. And remember, as I said before, this is not investment advice. But thank you for watching. Bye.